Hello, hello. Welcome to another episode of Financial Tides. This is your host today, Taylor Perillo, certified financial planner. Bringing the topic to you on financial independence. So, what is financial independence? We like to think of it as the point in your financial life that you can decide that you no longer have to work. You are completely covered for all of your needs and all of your goals. And that's a little bit different for everybody, and it can look different for everybody. So there's two different sides to this. There's either you have enough of your fixed and based income that it covers all of your needs, whether that comes from Social Security, rental properties, pensions, annuities, all of that, or you have enough saved up that you can create an income to live off of with your different assets in retirement, or a mix of both. So there's a lot of different variables that go into financial independence and determining when it is for you, and it can come at various age, various times, various income levels. So it's never really a one size fit all thing, but we're here to kind of discuss what it might look like for different people and how to figure out what it is for yourself. So we like to think of what's called a financial independence number, which is basically just a number that you need to get to with your money invested that you can live off the returns without having active job income or earned income that you're actively working on. So this number is going to obviously depend on what your different lifestyle is, what your investment returns are. So if you want to be aggressive or not, when you retire, personal expectations. So we need to kind of factor those different things in and then kind of work our way backwards to know what kind of number that you want to get to, which this is kind of the big overarching theme of financial planning. So, and it doesn't mean that you have to stop working just because you hit that number. It just means that you don't have to work and work becomes more optional and you have the freedom to kind of choose how you spend your time, which could be working, could be vacationing, traveling, doing kind of whatever you want. So, the big thing, why does knowing this number matter? And I think it's something that we experience with our clients a lot is once you go to work and know that work is optional, it changes the mindset that you actually have going into work. Work doesn't become this dread, it doesn't become this tedious activity that you have to do each day. It's now an active choice on a daily basis that you want to go in. You like the socialization, you like doing your job, it's rewarding to you. Or if it's not, you can pull the plug at any point in time. So it changes the mindset that you can really have going into work. And oftentimes it makes work more enjoyable. So it can reduce the anxiety and uncertainty of having to wonder if your job is going to be there and whether you'll get laid off or anything like that. So it kind of just gives you the ability to have a more balanced lifestyle. And then younger people, there's the term FIRE that is out there, financial independence, retire early. A lot of people are trying to figure out ways. I've seen Airbnb be a way that some people try to do this, is trying to get a bunch of Airbnb properties to create a passive income stream there. So that's kind of really the younger you want to go, the more likely it is that you're going to need to figure out ways to create passive income streams, whether that be through rental properties, whether that be through some sort of fixed income that you're continuously getting. But yeah, if that movement is really focused on creating income streams more so than it is actually saving money because you need it for such a long period of time and you need it basically very early in your career before you can have all the money saved up that's going to need to cover that very long period of time. So it's really important, though, to while you're figuring that out, take calculated risks and make wise decisions so that you're not jeopardizing your assets on the way. So, for those of you interested in the financial independence, retire early side of things, I'd say make sure all your basis is covered first because if you're taking high risk to try to get into that early retirement phase, you don't want to end up flopping on those risks, using all your assets that you had, and now being 5, 10, 15 years behind schedule for actual retirement because you didn't have anything saved and everything that you did have saved you spent on taking a risk trying to retire early. So I'd say it's okay to take a couple stabs at it, but make sure you're covering your bases first. As far as the other side of things, which is the more traditional side of things of saving assets and living off of those assets, there's something called the 25X rule, which is kind of the basic starting point of what you need. And that's just whatever your income is now, that you're living off of. So we're talking about take home pay. You can take your paychecks if you get paid 26 times a year every other week. Then the easiest way to do that is to just take one paycheck, multiply it over 26 weeks. That's what you're living off of, and then times that by 25. So that's roughly a 25-year retirement of how much you're going to spend. And this really comes from a 4% rule, which we've probably talked about in the past on podcasts. We've definitely talked about it in meetings, but if you take 4% of whatever your account value is, a 4% withdrawal rate will let your portfolio last for roughly 30 years without running out of money, at an average return. But that would give you enough income for a nice 30-year long retirement, taking only 4%, and the fund shouldn't run out during your lifetime. So that's back to those age variables of how long you're going to live, how early you're going to retire, because if it's only 30 years and you're planning on retiring at 50, you're probably these days going to live past 80, more likely than not, or at least you should plan to live past 80. So 30-year retirement might not cut it at the 4% withdrawal rate. So that's kind of just a starting point to work off of if you're looking to do it yourself and figure out what that number might be and give yourself a starting point without doing a deeper level of financial planning. And then if you want to get deeper, we have the software. We're happy to do it for you. So a basic example of this, if you have $80,000 a year that you're living off of currently, times that by 25, before you could have that financial independence, you would need to have $2 million saved. So that's just how it works. The basic plan, taking money from that, you typically would be able to get 4% from that a year and match your income. This doesn't account for any of the variables. So again, early retirement's one of them, high inflation. So a period like COVID where everything was going up at a very, very high inflation rate. It did not account for anything like that because those are going to mean that you need larger increases of your income. Your $80,000 that you were spending in the previous scenario is not going to spend like the 80,000 if everything increases in value year over the year the way it was during COVID. Another thing is major health events. So if you have one-off withdrawals because you had a health event that cost a bunch of money and it was out-of-pocket expenses, those one-off withdrawals above the 4% will shrink the account value quicker than what you kind of planned for. So again, this isn't a one size fits all, just do the 25-year rule and you'll be all set. This is just kind of a starting point for where you can get to if you're looking for a number to kind of ballpark you. Most of your savings being in a 401k account is something that you have to consider as well, or a traditional IRA, because you're going to have to pay taxes on those withdrawals. So when you're getting your traditional salary of $80,000, that's a net number that you're getting to your account. Taxes are taken out of there already. I know you have to settle up at the end of the year. Hopefully, you're appropriately withheld, but most of those accounts, 401k, traditional IRA, you have to account for taxes coming out of it as well. So if you were getting 80,000 take home and you're roughly paying 15% federally and 5% state taxes, you have to remember that working your way backwards, you're going to have to take $100,000 out to get 80,000. So that can cause account shrinkage quicker. So remember, gross and net numbers are different, and where the money is coming from in different accounts does make a pretty big difference when you're trying to estimate your financial independence number. The other big topic is just really getting an idea on retirement lifestyle and spending. I think a lot of people neglect the fact that what they're doing now while they're working and the hours and time and PTO that they have limits them compared to what they may be doing when retirement comes around. So I think you have to account for some different factors. The big one is typically travel. When you don't have a PTO requirement and you don't have anything keeping you in place or a job to come back to, travel typically spikes. You do a lot of the big trips that you didn't do during your younger years or when you had time requirements where if you wanted to go to Europe for 2, 3 weeks, you weren't able to do that because you couldn't get off work. So I think that's the big one that people forget about. And then the other different things is just accounting for housing. If you're going to stay in your current house, paying off a mortgage and completing your mortgage, you might have a little income boost from paying off your mortgage completely, or if you downsize and move to a lower cost area because you're not tied to any location for a job, want to be around kids or grandkids, those are things that could factor in. Healthcare, usually not too big at the beginning, but if you retire early, the out-of-pocket healthcare premiums is going to be a pretty big thing until you reach Medicare age. And then going on the flip side of that, after Medicare age, towards the later years of life, even though you might not be doing the hefty travel and leisure that you were doing before, your medical costs are likely to increase. Another thing to just consider is just children. A lot of people out there will want to support children in some way, shape, or form, whether it's a wedding, college, helping them transition to adulthood, getting their first home. So that's another number which could create additional withdrawals above your financial independence number that should be accounted for prior to making that decision to actually pull the trigger and retire. I think the starting point for this is really tracking your current spending. A lot of it will stay the same, so you want to look at your current spending, put check marks next to everything that will stay the same, and then kind of adjust for yourselves to say, hey, this might decrease in retirement. I'm not going to need gas to go to and from the office every day, but I do plan on taking an additional trip or two each year or going and doing this activity, picking up this hobby. I know golf is a popular one. So if you want to, if you say you're going to have a weekly tea time, that might be an additional cost that you didn't have before just because, or an extra additional tea time that you might have to pick up in retirement. So build a cushion. You don't want to underestimate this. This isn't something that you want to be running out of funds at the end of your life for. So if you overestimate, it's the classic over budget, underspend is much better than the alternative of under budgeting and overspending. So much better to leave something for an heir or a charity than it is to overestimate or underestimate and end up with having to live just off of whatever fixed income you had then. So there's definitely no shortage of free online tools to do this. We have very good planning softwares to help you and get an actual financial plan, give you a probability of success, and then make tweaks along the way. So I think the best way to do it, if you're willing to commit a little bit of time to get it set up, is to go through us and have us do it. But if you wanted to just do it yourself, you could plan on a spreadsheet. You could use a free tool online to get you kind of set up and started and kind of figure this out. But again, I think there's no reason to, if you're listening to this, to not. We'll do a free consultation for any non-clients, any clients. This is part of our services to you. So I think that you should get it set up, and that's part of the final thoughts is knowing your financial independence number gives you the power, it gives you clarity, it gives you direction. So you'll be able to then have control over what you do and what you choose. So starting with a rough number is always a great starting point, but get the full financial picture before making any concrete decisions. And also take advantage of the tools that we have for you. We're here to help and we want to help. So that's pretty much the idea behind this podcast is that we want to help you. We want to get you your financial independence number and we want to help you get there. So thanks for tuning in to another episode of Financial Tides. This is your host, Taylor, and have a great rest of your day.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.